Joining us today, Oppenheimer's managing director, Chris Kotowski, joins us on Some of the Banks. Chris, appreciate the time on an important day. What do you make of some of these reversals and also some of the filings we're getting from the likes of an FRC saying the deposit base is strong?
Well, we have been saying since last October, and the numbers clearly told you since last October, that that Silicon Valley is an outlier relative to the industry. And you could just see that in their results. It was clear in the third quarter results. It's clear in the fourth quarter results. So let me just give you an example here. For the average bank in the third quarter, their asset yields increased 22 basis points more than their deposit yields. For Silicon Valley, it was the other way around. Their deposit yields increased 36 basis points more than their asset yields. In the fourth quarter, it was the same thing. Where the industry, on average, asset yields went up 9 basis points more than the deposit yields, and for Silicon it was minus 62. So and you see it was stark in the fourth quarter. The average industry net interest income was up 8% linked quarter, and for Silicon Valley it was down 13. So it should not have been a surprise to anyone that they have issues that are different from the rest of the industry.
Right. I've seen a lot of the street today come to the defense of names. Schwab's a great example, where they compare just deposit growth over the last 3 years at SVB versus others like Schwab, nowhere near the same ballpark. But how do you characterize any kind of concerns about names that have had deposit growth over the last few years?
Well, it depends on what kind of. The problem with SVB, in my opinion, is that their deposit growth is almost all commercial, and it's a lot of venture-backed companies and so on. But in each case, there you always have a CFO or a treasurer that is trying to get the last basis point on rate. Whereas if you compare that to the average bank, right, the average account in the United States, I think, has $5,000 or $6,000 in it. And the retail customer has a couple of thousand coming in on the average month on direct deposit and a couple of thousand going out on bill pay, right? So, are people really going to move their deposits out, their operating accounts out of that? Are they going to go to HR and change their direct deposit bank and then re-input all their payments data? No, they're not going to do that to earn, 2 or 3% extra on a couple of $1,000s. It's the average retail depositor has their money in the bank for the convenience of that and the convenience of the branch and being able to go get cash out of a cash machine for free. That's why they leave their money in there. The only reason why a corporate treasurer leaves their money in a bank is that A, they think it's safe, and B, they're getting the best rate possible.
So what do you see happening to SVB? Do you see a buyout?
Well, it would take time in any case. These things don't happen overnight. And, one of the problems is that if somebody bought it, they would probably have to mark the whole held to maturity portfolio down as well. And that would be could be quite a significant write down as well. So I have a feeling they probably need to tough it out on their own, come up with Plan B, and then Plan B probably involves more of a balance sheet shrink and at some point probably raising equity, even if it is painfully dilutive.
Finally, can you characterize just for the sector in aggregate where you think commercial real estate risk stands right now?
I think in general, the banking industry has massively de-risked itself since the great financial crisis. And the asset quality numbers, I've been covering the industry on and off since the mid-'80s. And, it was always the practice that every 7 or 8 years they would have some kind of major accident. And I think the annual stress tests have really raised the cost of making a bad loan. So the banks make a lot less of them. And, the early delinquency data that I see are just off the charts low and good. So, I bet you there will be some office non-performers and probably some losses. That is not the bulk of the commercial real estate. I mean, when you think about a lot of the commercial real estate portfolios that banks have on their portfolio, a lot of it is apartments and hotels and logistics facilities, and all kinds of offices. Still is an important component, but it's a relatively small component.